Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. It's Friday. We made it to the end of the week. We got April 16th today. All right, so the stock market record high again on the Dow, record high on the S&P. Now, what we have going on is earnings seasons. Now, normally earnings seasons is a great time to be in the market. Over the last 25 years, if you took the average of all earnings seasons runs approximately 5 weeks. All right, so if you were in the market during this earnings season, you would have an average of almost a 17.5% return annualized, meaning every earnings season comes 4 times a year. You would have basically almost 5% upside to the market. So earnings season is great, except for when the stock market has already ran up too much. Whenever the stock market is more than 10% above the 200-day moving average, earnings season is not so good. Now, the earnings are good, but the stocks do not respond because it's already priced into the market. And that's where we're at right now. We're about 15% above the 200-day moving average. So I just want you to use caution here during this earnings season. Now, I have pulled some of my positions off. I'm still net long, but I have taken some of my positions off. I'm being cautious here. It's the prudent thing to do. All right, so let's move on to the housing market. Do you know the search that has gone up 3,000% in the last few weeks? The Google search, when will housing market crash, has gone up almost 3,000%. 3,000%. People realize that something is wrong in the housing market. I tend to agree with them. What's wrong is that it's being artificially propped up. We have an eviction moratorium. We have forbearance. We all know about this, but it keeps getting extended farther out. Okay, the Fed is keeping mortgage rates suppressed. They're doing this by buying mortgage-backed securities. They buy between $40 billion and $80 billion of mortgages every month. They already own $2.3 trillion of mortgages. 1 out of every 3 mortgage is owned by the Fed. So they're keeping the rates low. They cannot have the rates go up. What happens if the rates go up? Well, house prices go down. Now, after I leave here, it's interesting. I'm a real estate broker. It's what I do for my day job. Oh, let's call it that. Okay, I have to go meet with a client. Now, this client, it happens to be a friend of mine, and they are a young married couple that wants to buy a house. Now, as a friend, I'm trying to advise them to hold off as long as they can because I think the market is too artificially high here. We have record low in inventory, record low in interest rates, and we have record high prices. Is that a good time to buy? No, it's not really a good time to buy. So I'm trying to get them to hold off. Okay, that makes sense, right? But as a real estate broker, I would love to make the commission. I get paid 3% on $1 million home. That's $30,000, $2 million, $60,000. So I can make money, but as a friend, I got to convince them not to buy right now, to hold off if they can. But, there's arguments, though, that maybe you should buy now. Why? Why should you buy now? Well, because the government, the Federal Reserve, is going to keep printing money. And what happens? Okay, so they give this money to, let's call it a company like BlackRock. This is a hedge fund company, and they take this money out of their hedge funds, and they go and buy houses. They buy houses. Why are the hedge funds buying houses? Well, because basically they can get the money from the Fed almost free. Let's call it 1% they pay, maybe 1.5. Okay, so when they buy a house, let's call it a $1 million house, and maybe that $1 million house rents for $4,000 or $5,000 a month. Now, that $4,000 or $5,000 a month is a 4 to 5% return. So they can borrow money at 1.5%. Go buy a house and get 4 to 5% return. Now, okay, when they rent it. Now, that's if the person pays the rent. Right now, we have an eviction moratorium. So some of these hedge funds are waiting for the eviction moratorium to wear off so that they can kick the tenant out if they're not paying. But when they're getting money at 1.5% and they go buy these houses, they can get 4 or 5% return on their money. They're going to keep buying the houses. Now, what does that do? That takes the houses off the market, and this keeps the supply down. So that's the argument as to why maybe you want to get into a house right now, because they're going to keep doing this. They're going to keep doing this as long as the Federal Reserve keeps giving them this free money. They keep giving them this low interest rate money. Now, what else is keeping houses up? Well, builders. We can't build these houses. Why can't we build them? Well, we can't build them at a profit. Why? Because lumber prices hit a new record again this week. $1,260 for 1,000 board square feet. Okay, that is a record high. The price of lumber has tripled. What is that due to the builders? It makes their profit margins shrink. Now, yeah, they pass it along to the consumer, but the consumer can only afford so much. So builders have to pay more for the lumber. They have to pay more for the copper that goes into the plumbing, the pipes. They have to pay more in steel, which goes into the structure, the roof. They have to pay more. They have to pay more to build. And of course, labor costs are going up too. Why are labor costs going up? Because a lot of the workers, they want to sit home and collect unemployment from the government, cash their stimulus checks, and they're going to be fine. They don't need to go build houses. Building houses is hard work. Sitting at home on the couch playing video games, easy work. It's a no-brainer. Okay, so the builders have to pay a little bit more in wages to get their workers to come back to build these houses. So we're not getting many houses built. This is keeping the supply of homes relatively low, actually extremely low. All right, so we got the Fed keeping them low. We got corporations buying houses and taking them off the market, making them rentals. They don't want you to be the owner. They want to be the owner. They want you to pay them rent. Basically, you're the slave and they're the slave owner. Okay, they got the house. You got to go to work. You got to work 3 weeks just to get rent money to pay them. You get another week of work and maybe you get to eat. Look at that's a bad thing that's going on right now. And who's responsible for all this? Who's responsible? Well, of course, the Federal Reserve, by giving the free money to the corporations to go do this with. Okay, to keeping the mortgage rates artificially low. Look it. Real estate's a house of cards, and someday it's going to come down, but it's not coming down yet. It's not going to come down until we get rid of the eviction moratorium, until we get rid of the forbearance, until we get interest rates going up to normal levels, to 4, 5, 6% for mortgages. And it may go higher than that. It's overshot to the downside when it's spring loaded right now because they keep tightening that rubber band by keeping these mortgages low. No, it's going to spring higher, and maybe it's going to go to 6, 7, 8, 9% for mortgages. This is going to crash the housing market, but not yet. Not yet. It's not crashing yet. Will it crash by the end of this year? It might start. The interest rates might start to inflate higher. Okay, and that's going to bring the home prices down. That's true. That's going to happen. So what do I tell my client today? Do I tell them go ahead and buy a house here at these levels, at these inflated levels where they're getting multiple offers, where they're getting prices bid up to artificial high? I think if my clients buy a house today, they're going to be very sad a year from now, maybe 2 years from now it'll take. But I think they'll be very sad when that house comes down. 100,000, another 100,000, another 100,000, and all their equity will be wiped out. Yeah, they'll have a loan, but they'll be underwater. They'll be crying to me. I've seen this in the great financial crisis when they came back crying to me, Mike, I lost all my equity. And of course, whose fault is that? Whose fault? It's got to be the realtor fault, right? Realtor always gets blamed. They always get sued. Realtors get sued all the time. It's not my fault. I tell them, I go, look it, houses are artificially high. They're going to come down. You're going to put 20% down is what they're going to put down. Let's just use round numbers. $1 million house, they put $200,000 down. Okay, they got an $800,000 loan. What happens when the $1 million house drops to $600,000? Not only did they lose their $200,000, but they owe $200,000 more. It is the terrible feeling. It's a terrible feeling. They have to give the bank the house back because they can't pay the loan anymore and their credit's ruined. And the bank's going to take a $200,000 hit. All their equity got wiped out. What do I tell my client? It's really a conundrum here. Look, I'm just a dumb real estate broker, you know. I know what's going on, but I also want to make that big commission because we get paid a lot when we sell a house. Anyways, I'm going to try to talk them out of it. I'm going to try to talk them, hold them off for a year. If they can hold off for a year, I think they'll be better off. I'm Tall Mike. If you like this stuff, thumbs up. If you really like it, hit that subscribe button. We'll talk again next week. Get out there, have a great weekend, and we'll talk next week. Bye-bye now.